Brown beef costs almost $7 a pound. That's the latest reading, and it's up about 10% in a year. It sits just under the highest price ever recorded, which was set this spring. In the same window, the company whose name is on a lot of that packaging reported its results. Its beef division lost money. $142 million on a reported basis, $138 million adjusted. And it lost that money while charging 12% more. 8 days later, the second biggest packer reported the same thing. Record sales in its North American beef business, a negative result underneath them. So here's the question this video answers. You're paying near record prices for beef, and the companies you'd assume are pocketing it are losing money on it. Somebody in that chain is capturing your money. Who, and why can't anyone stop it? You already know what beef used to cost because you've been watching it move. Not in a chart, on a package. The one you pick up without thinking about it. The pound of ground beef that anchors a weeknight. You buy it so routinely that you notice the price the way you notice a stair that's gone soft. A year ago, that package was about $6.25, and it didn't spike. That's the part worth sitting with. Follow it month by month across the year. It climbs in steps, settles, climbs again. January, $6.75. It dips through the spring. Then it turns and keeps going. That's a grind, not an event. And a grind is what makes people angry, because there's no news story to blame and no week where it happened. So the explanation almost everybody reaches for is the obvious one. 4 companies slaughter most of the cattle in this country. The price at the counter is near its record. Somebody in the middle must be taking it. That story isn't a fringe theory. It's the premise of active federal litigation against the packers, brought by direct purchasers, by ranchers, by consumers. Those are allegations about conduct from 2015 onward. They haven't been decided, and nothing here is a verdict either way. But when you open the packer's own filings for this year, the numbers say something the gouging story can't explain. Here's what a beef packer actually is, because it decides everything that follows. A packer doesn't set a price and take a markup. It buys a live animal at one price, sells the meat at another, and keeps the difference. That difference has a name in the industry. It's called the spread. Cutout value, meaning what the carcass sells for, minus what the live animal cost. And a spread has a property a markup doesn't. It can go negative. If your input rises faster than your output, you don't make less money. You lose money on every animal while doing everything right. So let's test whether that's what happened. 4 steps. Step 1. The input. Tyson tells you the size of the shock, but not in a headline. It's in a cost line in the quarterly filing. Cattle cost the beef division about $525 million more in that one quarter than it had a year earlier. Across 9 months, close to $2 billion. Now hold those 2 bars next to each other because the ratio is the whole moral argument. The extra cattle cost in the quarter is about 3.8 times the loss the division reported. The packer absorbed most of that shock. What it didn't absorb, it passed to you. Step 2. The pass-through, which is what the 12% is. That's not greed showing up in the data. That's the part of the input shock that reached the counter. And here's why it wasn't enough. Volume fell almost 16% in the same quarter, so that extra cost was spread across noticeably fewer units. Per unit, the squeeze was bigger than the headline dollar figure by about 19%. So, put it the way the arithmetic puts it, the packer raised the price of beef by 12%, and it still wasn't enough. The cost per unit rose by nearly 19. The gap between those two numbers is about 7 percentage points. That gap is the loss. There's nothing else in it. Step 3. Where it went. Because if the middle of the chain is losing money and you're paying more, the money went somewhere, and it left a trail in public data. It went up the chain to whoever owns the animal. Feeder cattle, the young animals sold on to be fattened, went for about $376 a hundredweight in June. That's roughly $66 more than a year earlier. Finished cattle were up about 23. That's the answer to the question in the title, and it's worth saying plainly. The money on your receipt is being captured by the people who own the cattle, not by the company whose logo is on the package. And the reason it's locked there is the supply. There aren't enough cattle, and the people who could fix that are choosing not to yet. Beef cows are down another 1%. The calf crop is down too. Meanwhile, breeding heifers are being held back rather than sold, and cow slaughter is the lowest in a decade, which is the trap inside the trap. Every heifer a rancher keeps to breed is an animal that doesn't reach slaughter this year. Rebuilding the herd makes the shortage worse before it makes it better. Step 4. Ask the companies. They say it themselves in their own filings in flat language nobody's going to put on a poster. JBS wrote that the increase in live cattle prices outpaced the change in cutout values, reflecting the low cattle availability, and that as a result, industry spreads remained pressured. Tyson wrote that its beef segment continues to experience limited supply of market-ready cattle, as well as increased cattle costs, and that uncertainty exists regarding the timing of the cattle herd rebuilding. Read that second one again. The company being sued for setting your beef price is telling its own investors it doesn't know when the supply comes back. And they're not just absorbing it, they're shutting plants into it. JBS announced 2 closures alongside those results, one in Souderton, Pennsylvania, one in Memphis, Tennessee. Tyson's own filing explains its volume decline as lower head harvested from reduced cattle availability and, in its words, network optimization. That phrase is doing a lot of work. One half of that sentence is the shortage happening to the company. The other half is the company choosing to shrink. They're in the same clause. And now the part almost nobody reads, because there's a second set of numbers in that release, and it tells the opposite story from the first set. Across 9 months this year, on a reported basis, the beef division lost about $701 million. A year earlier, on that same basis, it lost about 707, essentially flat. Now, the adjusted numbers, the ones that strip out charges companies consider unusual, this year about $483 million. Last year, about $223. Look at those two panels together. On one basis, this business is flat. On the other, it more than doubled its losses. Same company, same release, same segment, same period. And the two numbers point in opposite directions. The gap is last year's add-backs, and there are 3 of them. $48 million of restructuring, $93 million of legal accruals, and the largest single piece, $343 million of it, is a write-down of the beef business's own carrying value. So the honest sentence, the one that says this business is deteriorating, is only visible on the basis that removes a write-down, and the basis most people treat as the real number is the one that hides it. The write-down itself is the tell. It came a year before the operating line admitted the trouble. The company had already marked down what it thought the beef business was worth. That's an observation about the sequence, not a motive I can read. Now the honest part, and it cuts against me, both Packers' beef losses actually got smaller year over year. Tyson's went from 459 million to 142 on a reported basis. JBS's went from 233 to 78. This is not a business collapsing. It's a business that can't make money on beef even while it improves. And a bigger one, which I want to be exact about, because getting it wrong would make everything else here worthless. Tyson, the company, is not in trouble. Its total adjusted operating income rose 8% this quarter. Its adjusted earnings per share rose 9%. Chicken alone earned $488 million. This film is about one segment inside that company. And that's not a hedge, it's the finding. Because Tyson's own forecast for the year says the same thing in its own hand. It expects the beef division to lose between $500 and $650 million. Inside a company, it expects to earn over $2 billion. One protein losing $500 million, inside a company earning over $2. That's a sharper statement about where your beef money went than any claim about the whole company could be. And it's the company's own number. So let's do the ledger. Everything here was lawful and disclosed. The question is, whose claim got stronger? The cattle owners captured it. $66 a hundredweight more on feeder cattle, $23 on finished. That's the largest identified transfer in the chain, and it went to tens of thousands of ranchers. They set no price collectively and can't be sued as a block. The beef division paid it. $525 million of extra cattle cost in a quarter against $138 million adjusted loss. Roughly $4 of cost shock for every dollar of loss it reported. The rest went to the counter as that 12%. You paid it. Almost $7 a pound, up about 10% in a year. You paid it into a chain whose most visible seller books a loss on the transaction. Your grievance is correct, your target is wrong. And the shareholders got paid throughout. Over those same 9 months, the company paid $529 million in dividends. It bought back $123 million of its own stock, and it cut its total debt by $824 million. That's the whole company across 9 months, set against the beef division's $701 million loss over exactly those 9 months. Chicken covered it. That's what a portfolio is for, and it's also who got insulated. And the people nobody counts lost. 2 plants retired into this. A closed plant is a permanent subtraction from the chain's ability to turn cattle into beef. And those communities don't get that capacity back when the herd recovers, which points at the uncomfortable ending. Even when the cattle come back, the bottleneck may have moved from the animals to the plants. The shortage changes identity halfway through, and your price stays high for a new reason. And there is relief with a date on it. JBS says live cattle imports from Mexico, shut for most of the quarter, were expected to resume gradually starting late this month. The cattle cycle has always turned eventually. This is where the margin sits now, not a prediction that it stays there. You are right to be annoyed at the price. You've just been annoyed at the wrong end of the chain. Because that's the end with a logo on it. So here's what I'd actually like to know. Now that you can see where the money went, does it change who you think should have to answer for the price? Or does it just mean nobody has to? And there's a second half to this. The plant's closing while the cattle stay scarce is its own story. It's the one that decides what beef costs 3 years from now. It's on screen now.